What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
We're about 4 months into this year, and what a year it's been for markets.
You said that last year, Stephen.
I think I did. You are correct. I think you'd be hard-pressed to find a period where there is just so much news flow that seems to be whipping markets around. But underneath the surface, the data's still been really great.
Yeah, absolutely. And that's certainly one big difference from a year ago or even the prior 3 or 4 years. We've definitely seen a broadening out of the macro data. And even in the month of April, that has absolutely continued. There's a lot of macro data out there. It doesn't all matter the same for equities, just like companies. I don't know, if you looked at their 3 major fundamental statements, cash flow, balance sheet, income, let's say there's 100 line items there. There's probably only 4 or 5 that really matter and that drive stocks, margins, revenue, earnings, et cetera, leverage. It's the same thing with macro. There's a lot of macro data out there, and leading economic indicators are those that not only lead the economy, and what I mean by that, GDP and payrolls, but they also more tightly correlate with equity markets, and more importantly, they correlate with equity market earnings. Because at the end of the day, a lot of this macro data is just company data rolled up. So in the month of April so far, when we look at the various leading economic macro data, we've seen some really good continued performance in PMIs. This week, we got a new 4-year high in the S&P Global U.S. Manufacturing Index that moved up to 54. In the month of April, also, we've been seeing strength in the Empire Fed Manufacturing Index, the Philly Fed Index. I believe the Kansas City Fed came out yesterday. That ticked down 1 point, but remained in positive territory. So considering all the fear around oil prices, and they've generally hung around about $90 this week, give or take, you continue to see strong resilience in the economic data that matters most for markets.
So the data has been good, and you were saying a lot of the regionals have already come in, and this isn't the first month. It's been a couple months of this, but it yet seems like all you hear about is oil.
Yeah, just like last year, all we heard about was tariffs. This year, we hear about tariffs and oil. If we think and look at the market's resilience in the U.S. particularly, I think if you break down the market by earnings and risk or PEs, you can better understand why the market's held up so well. We did see a double-digit drop in the market and an even much bigger double-digit drop in market multiples leading up until the bottom of the market in the end of March. But during that time, we also saw basically in the month of March, earnings were up about 5% on a forward basis. So the market didn't go down as much as multiples because earnings continue to incrementally move up and up. And it's the same story with respect to the concentration. It's still very much tech, and it's going to be tech because tech's a huge part of the index, and tech earnings continue to grow. And I've heard a lot of people highlight the point that tech has explained such a big part of the change in earnings estimates, and that's true, and that's going to be true for a long time. The question is, outside of tech, more from a company-specific number of companies level or breadth of companies level, how many companies are contributing to positive earnings surprises and positive earnings revisions coming from the sell side that is propelling that number. And again, the big difference between today and a year ago, small cap earnings estimates were still in a downward trend. Mid cap was okay. Large caps were straight up. Large caps are still straight up today. But this year, we've seen small caps and mid cap earnings estimates move up pretty sharply. So again, there's various ways you can see the breadth improvement we've seen from a macro perspective, from an individual company's perspective, and also from an index perspective.
That's a great point. If you look at just S&P 500 earnings or just some of the Mag 7 earnings over the last couple of years, they've been great, but you didn't have anything really behind that. And now you do. It has been a straight line up in small, mid, large, everywhere you look. It's just been a steady line higher in earnings expectations for about 7-8 months now.
Yeah. And that was certainly one of the early signs of the macro broadening that was taking place, which coincided with the beginning of seeing better PMI breadth and even seeing better housing data. Housing continues to be a big debate. Obviously, mortgage rates are up from where we started the year, which we got down below 6%. And we did see a resultant decline in purchase activity, but we're now, I think, starting to see that begin to improve again because we're now seeing the impact of rates coming down a little bit from their highs a few weeks ago. So no major change in the housing backdrop, but the data continues to be very rate reflexive. And we're still looking at housing and its improvement in purchase apps, which is about up roughly 20% from a year ago, 15 months ago, as still a strong leading indicator of better earnings profits to come, just more broadly in the economy. And I think that's one of almost a dozen measures that we look at that lead earnings breadth and lead PMIs that are all pointing in a direction that suggests that this macro strength and macro breadth is going to continue.
What are some of the signals we're seeing from the consumer and the consumer data? How is that looking? Because oil is kind of the front line of a lot of spending.
Yeah. And so sure, we're seeing it really have a negative impact on sentiment, which is not surprising. This week, we got another record low or near record low-ish consumer sentiment. And when you look back at past periods, sentiment was this low. We're talking about the depths of COVID, the depths of GFC, some pretty horrendous economic backdrops. And what I think we're seeing now in this new high inflation anxiety regime is a lot of the sentiment data, particularly around the consumer, is really more so reflective of price. People are just pissed off paying higher prices. Let's just say it how it is, rather than really being an indication of their future or current demand. And actually a fun chart I put together today just to highlight this disconnect. If you look back over the last 30 years or so, consumer confidence overall, or consumer sentiment, and consumers, the same survey, sentiment on where markets are going over the next year had almost a perfect correlation. So when consumer sentiment went down, people thought the market wasn't going up, and vice versa. And what we've seen the last few years is that's been pretty disconnected. And even looking at, again, the record low in the current MISH sentiment data for the consumer, that same survey still shows you that consumers on average still expect stocks to go higher next year. So how bearish could they really be? And again, it goes to, I think, my point, our point, that it's really just a reflection of higher gasoline prices and all the news about the potential for inflation to go back up and mortgage rates going back up. And then there's the whole political issue that's certainly being reflected in some of those survey data as well. So I'm not concerned by what I see from that. I don't think it's a measure of demand, current or future. I think it's just people really pissed off, rightfully so, that they're paying more money at the gas pump.
Yeah, price anxiety after that kind of inflationary shock we had it's a real thing. I know I still haven't become adjusted to some of the prices I see at the grocery store and when I'm out and about.
We're going to be talking about affordability for a very long time.
Really interesting, Michael. So one of the things we've seen over the last couple of weeks is tech surging again. Do you think we're back into that single game in town bifurcation, tech's just going, or are we going to continue to see what we saw a little bit at the beginning of the year, that broader, more participation in leadership?
Well, I think what we're possibly seeing, one, I think it's important to recognize that tech stocks underperformed quite a bit from beginning in last October. And the Mag 7, I think, declined about 17, 18% as a basket from their highs in October through the lows until the market bottomed. I think that's also important to contextualize the rebound we've seen, because I think essentially what we started seeing in the end of March as oil volatility, oil price levels, interest rate volatility started coming down, and you started hearing Trump talk about that they're starting to get negotiations and talking about ending the war. Obviously, that's helped sentiment quite a bit and has lowered risk premiums. So I think you've seen some money come back into U.S. markets. And I think what we saw initially, there was a surge of call buying. There was a surge of ETF buying, more so than single stocks. And obviously we have a very cap weighted market, and a lot of people still very much believe in the Mag 7 and the AI story, which you're clearly continuing to see the strength in the earnings estimates. I think at the end of the day, investors will continue to chase companies where their earnings are improving. While we've been recommending a broader portfolio in more cyclical areas of the market, like transportation and industrials and moving down into small caps into value since last September, it's really the big change is really not what's going on in AI, but really that you're starting to see some better macro data in the stuff that drives those stocks. So in a way, we're in a market where you still have this massive secular tailwind that is also broadening out from AI. And the difference between today and the last 3 years is that's in a way starting to begin to be joined by other parts of the economy that are also seeing a better macro and micro fundamental backdrop. So there's a lot of tech stocks that we like. Everyone's always concerned about what sectors you overweight, what sectors you're underweight. And we like to really give our favorite stocks within every sector. There's always stocks going up within every sector most of the time. And so we like to really get down and create a bottoms up view based on our macro and micro outlook. And a lot of the stocks that are in our long model within the tech space are those names that are continuing to see earnings momentum. And some of them actually are ranking or being flagged as even somewhat attractively valued today, or at least certainly that was the case a couple of weeks ago. So I think there's plenty of tech stocks that investors should continue to own as long as the earnings momentum story continues, and it looks like it certainly is. And at the same time, recognize that we're seeing a shift in the macro to the better, to the broader, and also looking for some of those positive opportunities elsewhere, where that really wasn't the case in 23, 24, and most of 25. And part of that was just, again, because the macro backdrop was extremely narrow and it stayed like that for a while, which led to a narrow earnings backdrop. And if we continue to see the PMI data go up, which usually corresponds with broader earnings, I think investors should look beyond the AI trade for stocks that are also seeing incremental benefit from better, broader global economy. And I think this is going to be an interesting earnings season because with the AI story, investors are going to be listening in to the CapEx announcements from some of the big hyperscalers and other large tech companies. We saw a short-term negative reaction when Tesla said they were going to be spending more money on CapEx, quite a bit more. But at the same time, I think everyone's going to be listening quite closely to how the changes in oil prices are going to impact company guidance. And that does play a much bigger role in the broadening theme, the cyclical theme, than it does the secular AI theme. So we'll see. I expect, given what we're seeing in the macro company-driven data in PMIs, that does suggest we should continue to see positive guidance from companies, or basically that, yeah, oil's up. Yes, there's uncertainty due to the Middle East conflict, but business is improving and we're going to continue to go in that direction.
Sounds good. Thank you, Michael. Pick it up again next week.
All right.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.